Today, we will be learning about the analysis of financial statements and security valuation. In this chapter, we will discuss 5 kinds of ratios and their interpretations. Then, we will move on to our bond valuation. We will discuss what is bonds and several characteristics of bonds and the simple math of how a municipal bond is valued or measured. So let's start today's class, which entitles Analysis of Financial Statements and Security Valuation. We will discuss financial statement analysis, then we'll move on to profitability ratios, following liquidity ratios, solvency ratios, efficiency ratios, market ratios, and finally security and bond valuation. So starting with the financial statement analysis, which comprises of 3 crucial types of analysis, which are horizontal, vertical, and ratio. First of all, we need to know that what are the financial statements that are intended to provide information on the resources available to management. So the balance sheets, the income statements, and the statement of cash flow provides crucial information to the stakeholders, and we use those 3 things to analyze our performance of a company. So basically, what is our main or major purpose of this analysis? We tend to seek to evaluate management performance in several important areas like profitability, efficiency, or risk, or even market analysis. This analysis can also provide insights that will help us to project future management performance. So basically, whether we should lend money to a firm or whether should we invest in it is completely focused or is completely dependent on a firm's expected future performance. So let's see what we have discussed, that it seeks to evaluate management performance in several important areas, and the ultimate goal is to provide insights that will help us to project future management performance. So the methods of financial statement analysis are several, but most commonly used are 3, which are horizontal, vertical, and ratio analysis. Horizontal analysis is basically a method that compares financial data over multiple periods to identify trends and changes in financial performance. It involves calculating the percentage change in line items such as revenues, expenses, and net income from one period to another. It is a crucial point where the comparison are made between periods, 1 year, 1 month to another month, 1 year to another year, and we express them as percentage of those changes. Then the vertical analysis is also known as common size analysis, where expressing each line item on a financial statement as a percentage of a base figure. For example, sales, we take sales as or net revenue as a base, and then we see how the other items changing based on the base figure. Moving on to the ratio analysis, which is a technique commonly employed by analysts examining a company's financial statements. For example, knowing that a firm earned a net income of 100 100,000 is not a very informative unless we also know the sales figure that generated this income, 1 million or 10 million, and the assets or capital committed to the enterprise. So if you break down which one is most important or which one gives us a better view of a firm, we can say each and every analysis have separate value to provide to the stakeholders. Horizontal analysis gives a comparison between periods, 2 or 3 periods or 5 years. Vertical analysis gives a comparison between how items are changing based on a base figure, and ratio is giving a total figure, a total measurement, a total analysis of the company as a whole. So in my opinion, it is better, ratio analysis is better from ratio analysis is better or is more effective for evaluating a company's performance and financial health. Other two are also important, but ratio analysis is more important for evaluating a company's financial performance. So there are several types of ratio analysis. It can be profitability ratios, liquidity ratios, solvency ratios, also efficiency ratios, and can also be market ratios. We will learn each and every single one in our next 3 sessions, inshallah. Starting with the profitability ratios, we will learn gross profit margin, net profit margin, return on asset, which is ROA, and return on equity, which is ROE. So let's begin with the profitability ratios, what they do and what they mean. Profitability ratios are financial metrics used to assess a company's ability. It usually assesses a company's ability to generate profits and earnings from its operation. How much profit they are making from their operations are usually measured by profitability ratios, which are gross profit margin, net profit margin, return on asset, and return on equity, which provide important insights in the company's efficiency and financial performance and overall a company's profitability. Some profitability ratios are mentioned earlier, and here we can see gross profit margin, net profit margin, ROA and ROE again. So discussing each and every one of them in details is not our goal of this course. Our goal of this course is to understand what each of the ratios mean and what they measure and how do we interpret them. Calculating formulas is very easy. You just put the numerator and denominator and you will get the answer, but interpreting the result is much more significant for this course, which is investment and management analysis, investment portfolio analysis. So let's start with the gross profit margin, where the ratio measures the company's ability to generate profit from its direct production or sales activities. It also measures the percentage of revenue remaining after deducting the cost of goods sold. So if we subtract cost of goods sold from net sales, we will get gross profit. So in the formula we can say gross profit divided by net sales. Gross profit is measured by net sales minus cost of goods sold. In this manner we can calculate the gross profit margin, but what this means and how should we interpret them is very much important. So the gross profit margin, please be careful in this section where the interpretation is much more important. The gross profit margin ratio indicates the percentage of revenue that remains as gross profit. I am repeating, the percentage of revenue that remains as a gross profit, which can be used to cover operating expenses and finally generate net income. Gross profit is a percentage of revenue that remains as gross profit, which can be used to cover operating expenses and generate net income. So if we get a higher gross profit margin, then we can say that the company has a higher probability, higher profitability from its core operations, as it is able to cover its production costs more efficiently. But a lower gross profit margin implies that the company has a lower profitability from its core operations, as it is unable to cover its production costs more efficiently. Moving on to the net profit margin, we will do an exercise after understanding each and every single ratios, and then we'll do a combined math to understand more how we can interpret the results. Let's discuss the net profit margin, which assesses the company's ability to generate profit from its operations. How do we get it? We just simply deduct all the expenses from gross profit and we will get the net income. Net income equals gross profit minus operating expenses, meaning operating expenses, taxes, interests, everything. Then we will divide it by net revenue or net sales, which is the same. And how do we interpret it? It is the percentage of revenue that is retained as net income, measuring a higher value which indicates that the company is more efficient in controlling its costs, generating its sales, and managing its overall operations. Moving on to the return on asset, it measures how efficiently a company utilizes its asset to generate earnings. It also measures a company's ability to generate profit relative to its total asset. And how should we calculate it? Earnings before interest and taxes will be divided by total assets. EBIT, which stands for earnings before interest and tax. We call it net income or net profit before income and taxes. But in the net profit margin, we deducted all the operating expenses, taxes, and interest, but in return on asset, we will not deduct the interest and taxes. We will take the net income before interest and taxes. It indicates that the percentage of profit generated per unit of total assets. However, a higher return on asset indicates that the company is more effective at utilizing its asset to generate earnings. And in a similar fashion, return on equity measures how efficiently a company utilizes the investments made by the investors or made by the shareholders to generate earnings. We calculate it by dividing the net shareholders' equity with net income. If we make it an equation, net income is divided by average equity or average shareholders' equity, which is the percentage of profit generated per unit of shareholders' equity. A higher return on equity, please be careful here, a higher return on equity suggests that the company is generating greater returns for its shareholders' investment. Please be careful. A higher return on equity suggests that the company is generating greater returns for its shareholders' investment. So for all the profitability ratios, the decision should be between 2 or 3 companies. The decision should be, we should select the higher one, the higher valued investment, higher valued stock to higher valued security or higher valued company to invest on that company. So if we move on to our exercise, we can see our revenue, gross profit, net profit, total assets and average equity have been given for 2 companies, company A and company B, and we should find the gross profit margin, net profit margin, return on asset and return on equity by implementing the previous formulas we have seen in our previous slides. So let's do the math and let's see the answers, and you guys can also do the math very easily. That's not our main focus in this course. Let's see the answers and let's see how we can interpret them. The first ratio is the gross profit margin. We say GPM in short, gross profit margin. We can see company A has 80% of that and company B has 20% of that. So we have learned that we should accept the higher one to invest in the company. And how can we interpret that? We can say company A has a higher profitability from its core operations, whereas company B has only 20% profitability from its core operations, which is not enough. In a similar way, we can say company A has 20%, but company B has only 2% efficiency in controlling its costs and generating its sales. And for return on asset, ROA, we can say that company A is more effective at utilizing its asset to generate earnings, as it has a higher value, which is 20%, but the company B only has 0.2%. Similarly, return on equity has been calculated 10% for company A and 0.4% for company B, which suggests that the company A is generating greater returns, higher returns for its shareholder investments than company B. So with this exercise, we will move on to the liquidity ratios and what are the specific measures of that and what they measure. We will learn that in our next slide. So let's see what liquidity ratios do. First, discussing the liquidity. What is that? Liquidity is the ability to convert assets into cash at short notice, which are used to assess a company's ability to meet its short-term obligations and measure its liquidity positions. But what liquidity ratios do? They assess a company's ability to meet short-term obligations and measure its liquidity position. Some liquidity ratios are current ratio, quick ratio and cash ratio. We will discuss that in a summarized view so that you can understand in a better way. The current ratio is the ability measures the ability of the firm to pay off its current liabilities by liquidating its current assets, for example, turning them into cash. So the equation is we divide the current assets by current liabilities. In all of the liquidity ratios, we divide each and every one of them with current liabilities. The first one, current ratio, the equation should be current assets divided by current liabilities. What it indicates that the number of times current assets can cover its current liabilities. So what does it interpret actually? It interprets that a current ratio is higher than 1 indicates that a company has more current assets than its current liabilities, suggesting a better ability to pay off its short-term liabilities. So if a company have more current assets than its current liabilities, then it can pay their liabilities with their current assets at the time of liquidation. When the company goes bankrupt, or when the company has to sell their assets and they cannot operate in the market, they can sell their current assets and they can pay their liabilities with their assets. And if they have a higher ratio, it indicates that they can pay their obligations very easily. But a current ratio below 1 may indicate that the company is facing liquidity challenges where the current asset is lower than the current liabilities. So the decision should be accepting above 1 is the standard decision. Moving on to the quick ratio, which measures how efficiently a company is utilizing its asset or its ability to pay off its current liabilities using its most liquid assets. So I'm repeating again, quick ratio is also called the asset test ratio, which measures a company's ability to pay off its current liabilities using its most liquid assets. The formula shows that current assets minus inventory divided by current liabilities, meaning we have to deduct the inventories from the current asset and then divide it by current liabilities, which indicates the company's ability to cover short-term liabilities using its most liquid asset. So how should we interpret it, and what decision should we take? A quick ratio greater than 1 suggests that the company has sufficient liquid assets to meet its short-term obligations without relying on the sale of inventory. But a quick ratio below 1 may indicate that potential difficulties in meeting short-term liabilities or short-term obligations with its liquid assets. The decision should be accepting above 1. I have summarized that for your usefulness and so that you can learn very easily. You can see the comparisons very easily. And I have also included exercises and these interpretations in the note, if you can follow in the portal. So let's move on to the cash ratio, which is the most conservative liquidity ratio It measures a company's ability to pay off its current liabilities using only its cash and cash equivalents. I'm repeating, only cash and cash equivalents will be used to pay off its current liabilities. So the equation will be cash plus cash equivalents divided by current liabilities. The interpretation should be that a higher or greater than 1 suggests that the company has enough cash to cover its short-term obligations, but below 1 shows that the company may need to rely on additional sources such as liquidating other current assets to meet its short-term obligations. So let's see another exercise which includes our 3 ratios where we can see current asset, current liabilities, inventory, cash and cash equivalents are given for company A and company B. You can also very easily calculate the amounts, and we will discuss the interpretation here. So we can see company A has a current ratio of 3, quick ratio of 2.4 and cash ratio of 2, which are above 1. So above 1 means a very acceptable decision. Current ratio above 1 indicates that it has more current assets than more current liabilities. Quick ratio above 1 indicates that the company has sufficient liquid asset to pay their debts or liquidity liabilities. Cash ratio indicates above 2 indicates that it has more cash to cover its short-term liabilities or current liabilities. On the other hand, company B has lower than 1 current, quick and cash ratios, which is a significant or potential risk and challenge they will face. 0.75 current ratio indicates a potential liquidity challenge. Quick ratio below 1 indicating potential difficulties in meeting short-term liabilities, and cash ratio below than 1, which is 0.5 in this case, indicates that the company does not have proper amount of or adequate amount of cash in their hands to pay their debts or short-term liabilities. So they should increase their cash flows and to improve the ratios. So finally, today we will learn about solvency ratios, and this is our last topic for today. We will continue the efficiency and market ratios in our next session, inshallah, with some more practices. So the solvency ratio comes, if we think about solvent means Shocholata. Solvency comes from that. If a company is solvent, then the solvency ratios will be showing a very good result. But if the company is not solvent, they cannot pay their debts, they cannot pay their long-term liabilities or short-term liabilities. So we have to measure their position, how much equity they have, how much debt they have, so that they can pay their debts. So if we can, if we say book definitions, we can mention that solvency ratios are financial measures that assess a company's ability to meet its long-term obligations and maintain its financial stability, which provide insights into company's financial health and its capacity to repay its debts. So some solvency ratios are debt to equity ratio, debt ratio, interest coverage ratio, and there can be others too, but we will focus on these 3 ratios here. So let's move on to our summarized ratios, which we will cover today. The debt to equity ratio compares a company's debt to its shareholders' equity. How much a company has debt and how much equity they have. The debt to equity ratio compares between those two things. So the formula should be total debt divided by shareholders' total equity. It also measures the proportion of debt financing relative to equity financing and provides insights into company's financial leverage and its ability to meet its long-term obligations. So how should we interpret the ratio? The debt to equity ratio indicates that the level of financial leverage or the extent to which a company relies on debt financing compared to equity financing, and provides the company a better position if they have more equity than debt. So a higher debt to equity ratio suggests that a higher degree of financial leverage, which can increase financial risk, meaning if the company has more debt than equity, then it can create a financial risk for them. Conversely, a lower ratio indicates that a lower reliance on the debt and a more reliability and more dependency on equity, which is a good thing, and it is a more conservative capital structure for a company. So the decision should be, we should accept the companies which have a lower debt to equity ratio to avoid future financial risk. See, in a similar fashion, debt ratio measures a company's assets that are financed by debt to its total asset. It provides important insights into the company's leverage and the extent to which it relies on debt to fund its operations. The ratio indicates the debt ratio. I'm repeating. The debt ratio indicates the proportion of a company's assets that are financed by debt, which means a higher debt ratio shows a higher level of leverage and indicates that a larger portion of the company's assets are funded by the debt. If we have a higher debt and a lower total asset, it means we have a larger portion of the company's assets funded by the debt. This can also increase financial risk and potentially affect the company's ability to meet its debt obligations. On the other hand, a lower debt ratio indicates a lower reliance on debt financing, which is a more conservative capital structure again, with a higher proportion of assets being financed by equity or other non-debt sources. So again, the decision should be accepting the lower one. A lower debt ratio is a good choice for a company. Moving on to the interest coverage ratio, which measures a company's ability to cover its interest expenses with its operating income. It provides insights into the company's ability to meet its interest obligations and indicates its financial health and capacity to service its debts. So the ratio also indicates the number of times, again, the number of times the company's operating income can cover its interest expense, covering interest expense with the operating income. A higher interest coverage ratio suggests a stronger ability to meet interest payments and indicate a lower financial risk. Here, a higher interest coverage ratio indicates a lower financial risk, which implies that the company has sufficient earnings to comfortably cover its interest obligations. On the other hand, a lower interest coverage ratio indicates a higher risk of not being able to meet interest payments. It suggests that the company's operating income may be insufficient to cover its interest expense, potentially indicating financial strain or a higher debt burden. So the decision should be accepting the ratio between 1 to 2. Moving on to our exercise. Here, total debt, total equity, total asset, operating profit, and interest expense have been given for company A, company B. We should find debt to equity, debt ratio, and interest coverage ratio. So here we can see the answers where company A has better ratio than company B. If you can see, ICR indicates interest coverage ratio. A little bit earlier we said that 1.5 to 2 is acceptable, but beyond that is very much appreciable for a company where the company can cover its interest expense 10 times of its operating income. So company B's interest coverage expense is also acceptable as it lies 1.6, which is between 1.5 and 2, which is also acceptable but not acceptable in comparison to company A. So thank you for attending today's class. We will continue the rest of our class in the next session, inshallah.